Good morning, everyone, and welcome to our Drop 2 webinar. I'm going to wait a few minutes before I get started just to allow some more people to join us. So once again, welcome to our first Drop 2 webinar, and we'll wait a couple minutes to allow people to join us, and then we'll go ahead and get started. Thank you so much. Good morning, everyone, and welcome to our first Deferred Retirement Option Plan 2 or Drop 2 webinar. So I'm going to go ahead and get started. We have a good group in. I know we have some more people that are supposed to be joining us, but I think I'm just going to go ahead and get started, and hopefully they'll be coming in shortly. So first and foremost, I just want to thank you all for your service to the citizens of Baltimore City. We appreciate all that you do. And I know you don't hear it enough, but just know that we genuinely are here for you. And we do thank you for your service. So the purpose of this presentation is today we are going to outline the F&P benefit that allows you to defer commencement of your retirement benefit while you continue to work after you meet Drop 2 eligibility requirements. And all that means is that today we are going to talk about Drop 2. So for specific information or to receive a one-on-one consultation, please contact F&P Member Services for an appointment to speak with a benefits analyst. So today we are going to go over some Drop 2 basics. We are going to discuss Drop 2 eligibility, Drop 2 participation, and post-Drop 2. And the whole reason that we're doing this is because it was brought to our attention that our members, although they may be going into Drop 2, they still don't have a full understanding of how it works. And one of my analysts by the name of Sade Brown came up with the idea, why don't we do a webinar to really educate our members? So hopefully they'll be more informed and more educated when it comes to how Drop 2 works. So what is Drop 2? So it is Deferred Retirement Option Plan 2. That's what it actually stands for. It was a benefit designed to retain members who are eligible to retire. It's a benefit that allows you to defer commencement of your retirement benefit while you continue to work after you meet the eligibility requirements for Drop 2. So during this deferment period, your Drop 2 account will be credited with retirement benefits that you would have received had you terminated city employment. Your Drop 2 account will consist of your annual F&P retirement benefits that we calculate as of that Drop 2 start date, plus your mandatory contributions for a maximum of 3 years. Interest on the account will be compounded annually at 5.5% as of June 30th of each year. After that 3-year maximum participation period ends, interest will continue to accrue on that money until you terminate your F&P covered employment or retire. When you commence retirement, you will receive that lifetime retirement benefit in addition to a Drop 2 account. So eligibility requirements. So for Drop 2, you must acquire a minimum of 25 years of credited service as a contributing F&P member. F&P will allow you to use up to 3 years of your eligible pre-employment military service to reach or attain the 25 years of service. However, your military documentation must be submitted to us prior to the Drop 2 start date in order for you to be credited with that time for eligibility. However, purchased and transfer service may not be used to acquire the 25 years of service except for the purchase of prior F&P membership service. In other words, if you have some time with another system, whether it be state of Maryland or out of state, you cannot use that time to get you to the 25 years of service. Now, if you were deemed a grandfathered member as of June 30th, 2010, your Drop 2 eligibility requirements are different. So as a grandfathered member, you are required to acquire only a minimum of 20 years of credited service. So how do you participate in Drop 2? Well, first and foremost, you must complete and sign an application to participate in Drop 2. Your completed application must be received by F&P no less than 30 days and no more than 90 days prior to your desired Drop 2 start date. And this is the same concept as with filing for retirement. After your application is received, your eligibility for Drop 2 participation will be reviewed by F&P, and if you are found to be ineligible, you will be notified by F&P in writing. In addition, If you're found to be eligible, you will also receive a letter from us confirming your participation in Drop 2. And we mentioned this before, but the Drop 2 participation is an initial participation of 3 years. So during that time, your Drop 2 contributions, well, your member contributions that you make every 2 weeks are going to go into this Drop 2 account during that 3-year participation period. So these contributions will be deposited in that account, and they're going to earn 5.5% interest. At the end of that 3-year drop participation period, if you continue employment, if you continue working with the, with the fire department or police department, your mandatory contributions, those monies that come out every 2 weeks, continue and resume being deposited in the mandatory accumulated contribution account. Now, when it comes to the service credit, all your service credits are suspended during your 3-year drop participation period while you earn that Drop 2 benefits. If you continue the F&P covered employment after your 3-year participation period ends, then you will resume earning the service credits. Now, those suspended service credits are not recovered. And I think a lot of people get confused with that. So for example, if you began Drop 2 with 25 years of credited service as a contributing member, and at the conclusion of that 3-year drop participation period, you will still only have 25 years of service with F&P, even though you have actually, been working for 28 years. So just be mindful that those 3 years, basically, you're not going to recover that 3 years. So as far as your minimum participation requirement, so to receive the Drop 2 benefits, you must remain a participant for a minimum of 12 consecutive months from your Drop 2 start date. If you retire, leave F&P covered employment, or pass away prior to completing the 12 consecutive months, you will be treated as if you've never participated, and you will not be eligible to receive the money that accumulated in the Drop 2 benefits. So remember, you got to stay in it 12 months. Now, if you decide that you no longer want to participate or discontinue, as we call it, your Drop 2 participation, and you want to remain an active member, but you want to continue working, you may only do so on your anniversary date. This form, so in order to do that, so say, for example, if you started Drop October 1st of 2025 and you wanted to discontinue, you cannot come to us June 30th of 2026 and say, hey, I no longer want to be in Drop. I want to come out today. You have to stay in it if you're going to continue working for at least a year. Okay, so you would only be able to discontinue if your Drop 2 start date was October 1st, 2025. You could only come out October 1st, 2026 or October 1st, 2027. If after 3 years, you've completed the 3-year drop participation period. But in order to do that, you have to complete this form, a discontinuation of Drop 2, and that's what I have a copy of here. And this form must be completed no more than 90 days and no less than 30 days prior to the first or second anniversary of Drop 2 participation. Now, you can retire anytime you want to, but if you want to receive the Drop 2 benefit money, you have to stay in it at least 12 months. Okay, when it comes to retirement and receiving the benefit. However, if you don't want to retire and you just want to continue working, because as we know, there have been a lot of raises, some raises, you all have been approved for certain raises. Once you're in Drop 2, you got to stay in it at least a year if you're going to continue to work. If your plans are not to retire, but to continue working, and you've entered Drop 2, you have to stay in it at least a year. And you can only come out, should I say, on those anniversary dates. Okay, so I just want to make sure that I'm clear. If you're going to continue working and you're already in Drop and you want to come, you don't want to stay the 3 years. Okay, you can only come out on the anniversary dates. So here are some examples of Drop 2. Okay, so this is kind of like how Drop 2 works. So what we do is, as of your Drop 2 start date, we calculate a normal service retirement. And this is going to be based on your total service credit as of that date and your average final compensation as of that date. And this is going to be called the frozen benefit. And so this is just an example of how we calculate it. So I'm just going to make up a date. Say the person's drop to start date was September 1st, 2026. We're going to look at the years of service. We're going to say, we're going to do the calculation. So for the first 20 years, we multiply that times 2.5% times, in this example, the AFC is $90,000. And that's going to give you $45,000. And then we're going to add to that 5 years, an additional 5 years times the 2% times that 90,000 AFC, and that's going to give you $9,000. We're going to add those two numbers together to come up with the annual retirement benefit of $54,000 or monthly benefit of $40,500. Now, had this member decided to retire on September 1st, 2026, this is what their retirement benefit would be. And if they left and, went somewhere else, we would be paying that to them, in their new endeavors as a retiree. But because they chose to stay and continue to work, instead, that money, that $54,000, will be placed into the drop account. So this is going to show you how that money accumulates. So the drop to account consists of 3 parts. The first part is going to be your mandatory contributions. And so that's the money that comes out of your pay every 2 weeks. Now that contribution actually is 10% of your biweekly salary. And this kind of shows how we come up with the amount. So in this example, the person's salary is $90,000. We divide it by 26 pays because that's how many times you get paid in a year. And we multiply that times 10%. So with an annual salary of $90,000, their contributions or mandatory contributions is $346.15 per pay period. Okay, so that's going to be your first part of the drop to account. The second part is that frozen retirement allowance, which I just discussed at the start of drop to. That's the second part. And the third part is going to be the interest which you earn at 5.5% until the date of cutoff. Now, let me just say this. Anyone who is non-grandfathered and who has already been in drop 2 for some time, prior to June 30th, 2025, you earned 3% interest. But after July 1st, 2025, that has increased now to 5.5%. So for purposes of this presentation, you will see us using 5.5% interest because that's what we're now paying everyone who's in drop 2 at this time going forward. All righty. So as we see the frozen benefit, as we already talked about that and went through those numbers. So the frozen benefit is $54,000 a year. Monthly, it's $4,500. So this is how it works. So for year 1, the mandatory contributions for 26 pays comes out. So when we multiply that, it's going to give you $8,999.99 of your mandatory contributions, which are now being deposited into the drop 2 account, okay, after your first year. In addition, that frozen retirement allowance, or we call it the benefit, drop benefit, is put into the drop account. So that's an additional $54,000, which gives you a total of $62,999.99 after the first year that's been deposited in that drop 2 account. And this does not include interest, okay? So as of June 30th, we apply 5.5% interest to that money. Next year, year 2, we have an additional $8,999 because that's your 26 pays of your contribution, plus an additional $54,000, which is that frozen retirement allowance or drop benefit, which gives you a total of $62,000, an additional $62,999.99. And then we apply interest on all of the money that's already in that account. So it's compounded. Okay. Then we come to year 3. We have an additional $8,999.99 plus the $54,000 gives you $62,999. And then we would apply interest. So just looking at these numbers, which doesn't include any additional interest, it's going to give you a total of $188,999.97 after 3 years. And like I said, this example does not include interest. And then just to let you know, if you get any raises, the frozen retirement allowance doesn't change, but your contributions will. So that number could fluctuate the contributions, okay? But I don't know about you, but I don't know how many people could save about $200,000 in 3 years. And pretty much the city is giving you that for staying and enrolling in the Drop 2 account. So now, there are 3 phases to Drop 2. And this is the part that I think a lot of members get confused about. Okay, so the first phase is early Drop 2. So, and this is the same for both the police and the fire department members, this phase. So if you retire during or at the end of your Drop 2 participation period, you will receive an early Drop 2 retirement allowance, which consists of your frozen retirement allowance, which is what we calculated as of your Drop 2 start date, plus the balance in your Drop 2 account. So when you retire and you've gone into Drop 2, as we discussed before, you're going to leave with 2 buckets of money. You're going to leave with your retirement benefit, which is a lifetime benefit. And then you're also going to have that second part, which is that drop money, or I like to look at it as a savings account with that drop money. So you leave with 2 buckets. Now, this is an example of what the retirement part is going to look like. So early Drop 2 is if you retire between 1 year after the Drop 2 start date and the Drop 2 end date. Oh, and I'm so sorry. Should you have any questions, please put your questions you have in the chat. And what I'm going to do is after I do the presentation, then I'll answer your questions. So I do apologize. So if you have any questions, if you can please type them in the chat. You won't be able to actually speak them, but if you type them in, someone will read them, and then I'll be able to answer them at the end of this presentation. Okay, so if you retire during early Drop 2, your AFC is calculated using the salary earned either 18 months if you're grandfathered or 24 months non-grandfathered if you're non-grandfathered prior to starting your Drop 2. So as we discussed before, there's going to be no change in your frozen retirement allowance calculated at your Drop 2 start date. So I have 2 examples here, okay? The first one is someone who's grandfathered, and we're talking about this early Drop 2, okay? So this person, the Drop 2 start date is March 1st, 2026. And the Drop 2 end date is February 28th of 2029. However, this person decides they're going to retire March 1st, 2028, which is 2 years after they go into Drop 2, okay? So if we look at the calculation, it's the 20 years times 2.5% times the AFC at the Drop 2 start date. Their retirement benefit would be $45,000, okay? This is for someone whose grandfather who decides to retire in early Drop 2. They only do 2 years in Drop 2. So we're just talking about the retirement part. We're not talking about the bucket of money, okay? Now, for someone who was grandfathered, in this example, same case, the person Drop 2 start date March 1st. The Drop 2 end date is 3 years later, February 28, 2029. They decide to retire after 2 years, March 1st, 2028. So we know for non-grandfather people, you got to do 25 years. So if you look, we did 20 years, 2.5% times 90,000, 45,000, plus the 5 years times 2% times the 90,000 is an additional 9,000. So they're going to leave with an annual retirement benefit of $54,000. So for your members who say, you know what, I'm going to go into Drop 2 and I'm going to retire only 2 years afterwards, be mindful that your retirement benefit is still frozen. We're still using the older salaries as when you went into Drop 2. So any raises that you would have received during that time period while you're in Drop 2 is not going to be factored in to the calculation of this retirement benefit, okay? So that's your early Drop 2. Early Drop 2, I'm going to repeat that, as if you retire, you go into Drop 2, and you retire between 1 year after your Drop 2 start date and the Drop 2 end date. And as we discussed, Drop 2 participation period is for 3 years, okay? Okay, so the next phase, and this is a little bit more complex, and I think a lot of members get stuck here, is the mid Drop 2. So we already talked about early Drop 2. So now we're going to talk about mid Drop 2. And when it comes to the police and fire, this is where they differ. Because there are different unions involved, they negotiated different contracts when it comes to Drop 2. So you're going to see a difference when it comes to how it's handled at this point. So for mid-drop 2, for police department members, if you all retire within 3.5 years following completion of your drop 2 participation period, you will receive a mid-drop 2 retirement allowance, which consists of your frozen retirement allowance calculated as of your drop 2 start date, plus for each year of service credited after your drop 2 participation end date, a retirement allowance of 2% of your new AFC, okay? Plus the balance in your drop 2 account. Okay, so your new AFC will include salary increases that you received after your drop 2 start date, but it's only going to be applied towards your years after your drop 2 participation period. And I'm going to show you that in the next example. Okay, so this is kind of showing you the numbers. So I'm going to go over this with you. So mid drop 2, once again, as we discussed, is going to be if you decide to retire within 3.5 years after your drop 2 end date. So if you retire during this period, the frozen retirement allowance as of the drop 2 start date is added to service credit earned after drop 2 ends. Your AFC towards the time worked after drop 2 ends is then recalculated using salaries earned 18 months if you're grandfather or 24 months if you're non-grandfather before your retirement date. So in this first example, the grandfather person, we're looking at someone with a drop 2 start date, March 1st, 2026, end date, February 20th, 2029. They decide to retire March 1st, 2031, which is 2 years after they come out of the drop 2. So here we go once again, looking at the calculation. The 20 years times 2.5% times the old AFC is going to give you that $45,000. Now we have the 3 years in drop 2 where they're not earning any service credit at all. Plus now they came out of drop 2, they completed the drop 2 participation in 3 years, they came out and now they're earning the service credit again. So they did an additional 2 years times 2%. Now we have a new AFC as of the retirement date. And as you can see, this is $100,000. However, this new AFC is only applied to the 2 years after the drop 2 participation date, drop 2 participation ends, okay? And so when you take that 2 years times the 2% times the new AFC, it's only giving you an additional $4,000. So it increases it a little bit more. So now you're looking at a retirement benefit of $49,000, okay? Now we're going to look at the non-grandfather. So same scenario as far as the dates. With this person, of course, they have to do 25 years with an AFC of $90,000. And so so we show that here. They have the 3 years in drop 2 where they're not earning any service credit. And now we're looking at the time after the drop 2 participation period. So we take the 2 years times 2% times a new AFC of $100,000. And once again, it's an additional $4,000. So it's not a whole lot more, which gives you $58,000. So it does increase it, but it's not a whole lot. So for those members who are like, you know what, hey, I got some raises, I'm coming out of drop, but I'm only going to, do 2 years after drop ends. Yes, you may have gotten your raises. Yes, it may be a new AFC, but we're only going to apply that new AFC to the couple of years after when you came out of drop. That frozen retirement allowance does not go away if you're within this mid-drop 2 period. So that does not go away. Okay. So now we're going to talk about the fire department, which is a little bit different. So it's still the mid-drop 2. If you, as a member of the fire department, retire within 5 years following completion of your drop 2 participation period, you will receive a mid-drop 2 retirement allowance. And we're talking about the retirement benefit, not the drop 2 account. That's separate, okay? Your frozen retirement allowance calculated, you'll receive a frozen retirement allowance calculated as of your drop 2 start date, plus for each year of service credited after your drop 2 participation ends, a retirement allowance of 2% of your new AFC, plus a 1.5% recovery rate of your new AFC per year for the first 4 years of service credited after your drop 2 participation period ends, okay? Plus the balance in your drop two account. So the fire department is handled differently. So they have that recovery rate, but they also have to stay longer. Okay. Now note your new AFC will include salary increases that you received after your drop two start date. Now, just to explain what a recovery rate is, the drop two recovery rate replaces service credits that you did not earn during your drop two participation period. And it begins when you resume earning service credit after your drop two participation period ends. So after the drop two end date, that's when you start resuming earning the service credit. And this is only for fire department members only. So that recovery rate is 1.5% per year of your new AFC for that first 4 years after their drop two end date. So your recovery rate is equal to the lesser of 1.5% per year of post-drop two service up to 4 years, which is 6%. And so what it does is it allows you to recover the 6% you would have lost for those 3 years of drop participation period, okay? Or it's going to be 2% for each year of drop two participation. And all that is, that's talking about people, for example, who decide to discontinue. So if you discontinue drop two on the first anniversary or of your drop two start date and work for 4 years after your drop two participation period, your recovery rate will be limited to 2%. And it's going to be 2% times the 1 year of drop two participation. And all that's saying is, because you only did for this person, if they decide to discontinue after only 1 year of drop two, but they work 4 years afterwards, they're only going to recover 2% because they basically came out of drop two early. So they're not going to be able to get the 6% that someone who stayed in for 3 years got. The same thing is if you continue drop two on the second anniversary of your drop two start date and work for 4 years after your drop two participation ends, your recovery rate will be limited to 4%. It's the 2% times 2 years of the drop two participation. And it's because, once again, you came out early. You didn't stay the full 3 years. So you cannot get the 6%. So note, police department members, you do not have a recovery rate to replace the service credits not earned during the drop two participation period. So this is only for members of the fire department. Okay, so this is how it looks as far as the example and the numbers, because I know some people are visual. So we wanted to give you some figures to see how this works. So once again, mid-drop two is if you decide to retire within 5 years after your drop two ends. So if you retire during mid-drop two, the frozen retirement allowance at drop two start date is added to service credit earned after your drop two ends. So your AFC used towards the time after drop two ends is recalculated. So we're using newer salaries earned 18 months if you're grandfather or 24 months if you're non-grandfather prior to your retirement date. And once again, the drop two recovery rate is for members of the fire department only, and you do receive the 1.5% recovery rate of your new AFC per year for the first 4 years of service credited after that drop two participation. So here's an example of a grandfather person. We have the drop two start date of March 1st, 2026. Drop two end date February 28th, 2029. So this person decides to retire 2 years after that, which is March 1st, 2031. So with the grandfather, remember, as you see, for the first 20 years of service times 2.5%, we're using the old salaries, the old AFC at 90,000, and that equals a 45,000. So this does not go away. And if you look at it, the majority of your years, we're using the old salaries, the old AFC, in order to calculate that. You have your 3 years in drop two. Well, remember, you're not earning your service credits. So you're not getting anything. Well, you're getting a drop account, but you know what I mean. Okay, plus now we're going to look at the service credit earned after drop two. So for this person, they did 2 years. So we have the 2 years times the normal 2% that they would get times the AFC, the new AFC of $100,000 is going to give them $4,000. Now for the fire department, they also get for those 2 years that recovery period, that 1.5% times the new AFC of $100,000, which is going to give them an additional $3,000. So now their retirement benefit is going to be $52,000. Okay, but as you can see, it only increases the benefit a little bit. because of the fact that they're still in that mid drop 2 period. So during mid drop 2, we're actually using 2 AFCs, and your older AFC is being used towards the majority of your years of service. And your new AFC or newer salaries or higher salaries are only going to be used towards the years after you come out of drop 2. Okay. Now we're talking about someone who's non-grandfathered. Same dates we're using. As you can see, for the frozen retirement allowance, we still got that old AFC, so that does not go away. They do their 3 years in drop 2. Now we're going to look at the years after drop. We're taking the 2 years times the 2%, times 100,000, another 4,000, plus the recovery percentage times the 2 years times 100,000, another 3,000, which increases the benefit to 61,000. So, the early would have been 54. You get about 7,000 more for mid, about 61,000. But it, like I said, it just increases it a little bit more, but it's not a substantial increase. And so now we're going to talk about the final phase of drop 2, which is going to be complete drop 2. So this is the one, if you're able to stay this long, this is where I kind of tell people you maximize drop. So for the police departments, as we talked about before, because the 2 different unions negotiating this, it does look differently for complete drop 2 also. So for police department members, if you retire 3.5 years or more following the completion of your drop 2 participation period, you will receive a normal service retirement allowance calculated based on 2.5% of your refreshed AFC multiplied by your first 20 years of credited service as of your drop 2 start date, plus 2% of your refreshed AFC multiplied by your years of credited service over 20 years as of drop 2 start date, plus 2% of your refreshed AFC multiplied by years of service after your drop 2 participation end date through your date of termination from employment, plus the balance in your drop 2 account. So bottom line is, when it comes to refreshed, what that means is now we're using all new salaries. So the frozen retirement allowance goes away. And I thought I had to screen that, explain it, but we'll get to that later. But your old salaries go away, and now we're looking at new salaries. So complete drop 2 for police, we're going to show you an example so you can see the numbers and what that actually looks like. Is if you retire 3.5 or more years after drop 2 ends. So if you retire in complete drop 2, your AFC is recalculated using the salary earned 18 months if you're grandfathered or 24 months if you're non-grandfathered prior to your retirement date for all your service credit earned. So this is multiplied by your years of service before you went into drop and after you come out of drop. And so in this example, you have the drop 2 start date of March 1st, 2026, drop 2 end date February 20th, 2029, retirement date. As you can see, they're retiring March 1st, 2033, which is 4 years after they come out of drop. So now we're looking at 20 years times 2.5% times a new AFC of $105,000, which now gives them $52,500. 3 years in drop 2, not earning anything. And now we're looking at the time once you come out of drop 2. So now we're looking at the 4 years once they came out of drop times 2% times that new AFC of $105,000, which is going to give them an additional $8,400. So now their new retirement benefit is $60,900. Now for non-grandfather, we're utilizing the same dates, looking at, the first 20 years, we're using the 105. We come up with the same 52.5. However, they have to do the 5 years times 2% times the 105, which is now an additional $10,500. You don't earn anything during the 3 years in drop 2. We're looking at the years after drop 2. So we take those 4 years times the 2% times the new salary, new AFC, 105,000 gives you an additional 8,400. And now we have a new retirement benefit of 71,400. So the bottom line is that by staying until complete drop 2, now you can fully benefit from any raises that you would have received during your drop 2 participation period. because now we're using only the newer salaries to calculate your retirement benefit for all your years of service that you've earned. So for the fire department, as far as a complete drop two, if you retire 5 years or more following the completion of your drop two participation period, you will receive a normal service retirement allowance calculated based on 2.5% of that refreshed AFC multiplied by your first 20 years of credited service as of that drop two start date, plus 2%. I'm just going to say your new AFC. We're just going to say new AFC multiplied by your years of credited service over 20 years as of drop two start date, plus 2% of that new AFC multiplied by years of credited service after drop two participation end date through your date of termination. Plus, you will get that 1.5% recovery rate of your refreshed AFC for each of the first 4 years of service credit after your drop two participation ends, plus the balance in your drop two account. Now, refresh means that your normal service retirement allowance as of drop two start date or that frozen retirement allowance is no longer used. Your AFC as of your drop two start date is no longer used. Your refreshed AFC is calculated as of your date of termination from employment, and all service credit is used except for your drop two participation service. So now we're going to see what that looks like as far as numbers. So once again, complete drop two is for someone who retires 5 or more years after drop two ends. So that would be like a total of 8 years, 3 years drop participation, 5 years afterwards, if you have it in you. If you retire in complete drop two, your AFC is recalculated using the salaries earned 18 months grandfather or 24 months non-grandfather prior to your retirement date for all service credit earned. So once again, we're looking at the grandfathered example. Drop two start date, March 1st, 2026. Drop two end date, February 28th, 2029. They come out March 1st, 2034, which is in this case 5 years after the drop two end date. So as you can see, we do the first 20 years times 2.5% times 1. Now you're looking at a salary of $105,000. That's going to give you $52,005. For grandfather, there's no, of course, you don't earn anything during drop two. Now we're looking at the time earned after drop two. So we're doing 4 years times 2%, which is the norm, times the new AFC of $105,000 is going to give you $8,400. Then we're going to do that recovery period. So it's going to be the 4 years times 1.5% times the AFC of $105,000, which is going to give you $6,300. Then, because it's 5 years after, that 1 year only is getting that 2% times the AFC of $105,000, and that's going to give you an additional $2,100. So now we're looking at a retirement benefit of $69,300. Now for the non-grandfather, we're looking at the same dates. And I'm not going to go through all of these again, but as you can see, prior to drop two, we're now using the new AFC of $105,000. So that gives you, you're looking at higher numbers already. We do the 3 years and drop, you don't get anything. But now let's look at the service credit earned after drop two. Once again, you see how you're getting, for the 4 years, you're getting the 2%. We're getting, times the new AFC. And then you're getting the recovery percentage of 1.5% times that 4 years after drop to give you that additional $6,300. And then for that additional 5th year, you're getting 2% times the 105, an additional $2,100 to give you a retirement benefit of $79,800, which is substantially more than the mid drop. Let me go back just to show you that mid, where it was $61,000. So we went from $61,000 to $79,000, and the $52,000, to $69,000. So as you can see the difference, it matters when you decide to retire and how long you decide to stay after you go into drop two. I think a lot of people, when they go into it, they're only thinking about their drop two account where the money accumulates. But you also need to factor, okay, how long am I going to stay in it after I come out of drop two, because that's the part that's going to impact your retirement benefit, which is the lifetime benefit. Okay. The drop two account is the lump sum money, but that retirement benefit is the lifetime benefit. So, with that being said, this is a copy of what an estimate would look like. So, when you request an estimate from us or when you decide to retire, we're going to provide you something that looks like this. And the first part is going to show you, and I don't even know if the numbers are small, but I'm just going to kind of go through it briefly. So the first part is going to show you what your annual retirement benefit would be, what the monthly benefit would be. And then below that, because like I said, when you go into drop two, you're looking at two buckets of money. So the first part is the retirement benefit, which is what we were talking about in detail. Now, the second part is the drop two account. So in this example, this person has a drop to account of about $248,000. Their annual retirement benefit is $93,000, $93,021.88. Monthly $7,751.82. So that's the lifetime benefit. Now the drop two account is split into three different sections because you have three options with your drop two money. So in this example, you can roll it over, which is the first option. So you roll it over to a qualified retirement account at a financial institution of your choice to avoid paying taxes on that money. So in this example, they have $248,000. I'm just going to round it off to roll over to that qualified retirement account and avoid paying taxes on that. Second option that you have with your drop account is you can annuitize it. And this is when you decide, I'm going to keep the money with the Fire and Police Retirement System, and I'm going to add it to my retirement benefit to give me an increased lifetime annual retirement benefit. So in this example, they had a drop account of $248,035.85. And what we do is we divide it by an annuity factor based upon the member's age at retirement. In this case, that number, I believe, was 15.430, which gives them an annual drop annuity of $16,074.91. So we take that total drop account, we divide it by a number based upon the member's age, and whatever we come up with, that annuitized or annual drop amount gets added to the member's retirement benefit of $93,000. And so what that does, it increases their retirement benefit to now $109,096. So they're not going to get a separate drop check because that drop is being added to their retirement benefit and is going to be paid to them monthly. So now their retirement benefit is no longer $93,000. It is now $109,096.79, monthly $9,091.40. And this is now the lifetime benefit that they will receive for the rest of their life. So regardless if the money runs out, this is what their retirement benefit will be. The third option is the lump sum. And this is where you decide, hey, guess what? Give me my money. I want you to make a check payable to me to do whatever you want to do. You want to buy a new house, pay off your house, buy a boat, buy a new car, pay off your bills, whatever you want to do. However, we're going to tax that money. So you have to pay upfront 20% to the federal government. So in this example, their drop account started at $248,035.85. 20% of that would go to federal tax, would be $49,607.17. So out of $248,000, $49,000 is going to Uncle Sam. Then you have to pay 7.75% if you live in the state of Maryland. So that's an additional $19,222.78 that you have to pay. So that leaves a balance to this member of $179,205.90. So right off the top, they have just paid about $68,000 in taxes. Now, the other thing is that if you are under the age of 50 and you take the money as a lump sum, you could be taxed, receive a 10% penalty for being under the age of 50 and taking that money. And also, it could put you in another tax bracket where you could owe additional taxes that way. But I'm not an accountant. I'm just telling you the information. So this is pretty much what you would receive when you do request an estimate. So at this time, I know I've given you a whole lot of information, but at this time, should you have any questions, Now is the time.
Okay, Tracy, you have a question. If you do the annuity with F&P and you die, does your spouse lose 50%?
So no. So what happens with that is your spouse isn't, if you select the maximum benefit at the time of retirement, whatever your annual, whatever that increased retirement benefit is, your wife will receive half of that for her lifetime. So hopefully that answered their question. So it will be a lifetime benefit for her, but she would only get, if you select the maximum, she would get 50% of that higher amount for her lifetime.
Okay, we had one other question. I did not receive mail with the code to allow me to look at my drop information.
Okay, now if they're referring to the statement, they can call into the office, and what we can do is we can email them the information, the access code, so that they can access their, well, we can also mail a statement if they haven't received it, or email them a statement, but also on that statement has the access code so that they can also go online and look that way and access the advance estimate. But we can send a new statement to you so you can see what your numbers look like.
Okay. Is there a particular benefit? Is there a particular benefit for each payout option, or is it just a personal preference?
It's a personal
Other
preference.
than the tax
Um,
penalties, of course. Excuse me. Other than the tax penalties, of course.
Yeah, it's really based upon a personal preference and what your financial goals are. A lot of times, and I just recommend this to anyone, as you get closer to retirement, is to really assess, what your goals are, try to pay off your bills and try to see what you can live off of. And I think when you do that and start speaking to financial advisors so you can get an idea of what your plans are for retirement, what do you want that to look like? And I think once you get an idea, then that's going to help you determine what you want to do with that drop money.
Okay. What is the actual benefit of doing the drop to just compared to just accruing time and then retiring?
Well, and this is just my personal opinion. I feel like it allows you to, I'm going to say save money, although it's technically not yours. The city pretty much is giving you the bulk of it. To accrue a substantial amount of money and a little bit of time. And then that money belongs to you. So when I talked about that frozen retirement allowance, basically the city is giving you your retirement benefit in an account for you to stay here. So for 3 years, they're giving you your retirement benefit and putting it into an account for you, and it's earning interest and accruing interest. So in my personal opinion, it's a way to accrue a substantial amount of money. And technically, if you decide, you can annuitize that money basically and add it back to your pension to increase it. And I know some people say, well, I've gotten some raises, so I don't know about going in a drop. I may just want to work and get the raises on, in my retirement benefit. And you can do that too. You can do that too. But there's also a way of accruing the money and then annuitizing it to also increase your benefit. And I know, so I don't know if that answered your question, but yeah.
Is
We'd
there
have to look at the numbers. Go ahead.
is there any difference for MAPS employees?
Um, when they say no, no. I mean, it's just the money would be different because your salary may be higher as a MAPS employee, but there isn't any additional benefit for being a member of MAPS when it comes to drop two than a member who's not a MAPS. It's the same benefit to both.
If I use my 3 years military and I enter at 22, do I enter at step 22?
So I'll say it like this because I know that you all look at the time a little differently when it comes to the police department. So I think you all start your step one on your first day, where we look at it as a year completed. So I'll just say this, it has to be 22 years service credit, and we can tell you what that is. And just to give you an example, so for somebody who, okay, for somebody who went into, okay, started with the police department, we'll say in 2000. We'll just say, I'll just make up the date today, August 13th of, let's make it easy, August 1st of 2000. August 1st of 2022, they should have 22 years. And then if we add, wait a minute, did I do that right? 22 years. Yeah, 22 years. Yes, August 1st of 2022, they would have 22 years. And then we could add the 3 years of drop to get them, I'm sorry, 3 years of military time to get them to the 25 years. So you have, I guess it would be like 22 years completed, if that makes sense. So I would need to see, so this is my suggestion to you. I would call into the office and speak to an analyst, and that way they can look at your specific pension entry date and look at your time and tell you when you would be eligible to go into drop two. That's the best way I can do it because I don't want to confuse you.
Okay. Do you have to enter drop on anniversary date, or can you enter anytime after you meet the eligibility requirements?
Anytime after you meet the eligibility requirements. We have people who wait years before they decide to go into drop two. But you just have to, the minimum is that you have to meet the requirements. And then you can go in immediately, or you can wait a year or two afterwards. Totally up to you.
Okay. Will this webinar be available to review at a future date?
Amy, I'll let you answer that.
The answer is yes. It will be available within the next 24 hours. It'll be up on the website and our YouTube page. Okay. Is it true that once you reach 59.5 years, your drop money is tax-free?
I've never heard that before, and I've never seen that. If you're taking it as a lump sum, we're going to tax it. So I'm hoping that answers your question. So yeah, if you take it as a lump sum, it's going to be taxed.
Okay.
Regardless of your age.
Is it worth it to do just 1 year, or is 1 year not beneficial?
And that is a personal preference. I will say this, I don't know how beneficial it is for just 1 year. Yeah, I'm not sure how beneficial, because I feel like there's other ways you could probably save some money. And yeah, it depends on your preference. I personally, and I'm going to be real honest, you have to make your own decision. I'm not sure how beneficial it is for just 1 year. And it depends on what you decide to do with that money. Are you going to annuitize it? Are you going to retire and annuitize it? Are you going to just do 1 year and then come out and continue to work? So, there's some other questions that I would like to ask before I just give a straight answer to that. But on the top of my head, I don't know how beneficial it would be without knowing, without you answering some additional questions. I'll say it like that.
Okay, circling back to the MAPS employee question.
Mm-hmm.
MAPS are not in the local unions, and some of this has been negotiated by the unions.
Mm-hmm.
So, does it make a difference?
It does not, because this is something that this is in our law. So it's a benefit that we offer to all sworn members of both the fire and the police department. So regardless if you're MAPS or if you're not MAPS, this is a benefit that's offered to all of our members of FMP.
Okay, so you only get the drop interest on June 30. It's not daily interest. So you should always wait a little while after leaving drop to retire for real, so you don't miss that June 30 interest add-on.
Well, I'll say this. Technically, no matter when you retire, we're going to give you interest for that date. However, in our system, it's applied on June 30th. So say, for example, if you wanted an estimate for, say, September 1st, 2026, we're going to calculate the interest for, how can I say this, for all the way up until, your cutoff date, August 31st. So you're going to get interest for every day it's compounded. It's just that we only apply it on June 30th. So you're getting interest. I'm trying to think of the best way to explain it. So you're getting the interest. It's just that it's only applied at the end of the year, at June 30th. But if you decide to retire any other date other than that, we're still going to give you the interest up until that date, whatever that date may look like. If you decide to retire January 1st of 2027, we're going to give you your interest up until whatever your cutoff date. If it's December 31st, 2026, We're going to give you the interest up until that date. So we apply it in our systems on June 30th, but the interest is being accrued daily. I'll say it like that. It's accrued daily, but it's just applied or added into the system on June 30th. So hopefully that made sense to you.
Okay, that takes care of all of our questions.
Okay, now we're not finished yet.
Wait a minute. I think, okay, wait a minute. Wait a minute. Okay, so we have a question about how is AFC? And that's just the question.
Okay, so the AFC stands for Average Final Compensation. And what that is, it is a weighted average of your salaries. So it does, go ahead.
Yeah, so how is the AFC calculated? Yes.
Okay, so the AFC, so it's a weighted average. So we're looking at your highest annual salaries as of, say, your retirement date. And we're not including any overtime. We're not including like any like incentives or stuff like that. We're looking at whatever that negotiated annual salary is. And what we do is we look at it over a span of 24 months, and it's a weighted average. So we're looking at, okay, this person has 6 months at 100,000. They got a raise from this date to this date, so 105,000. Then they got a raise from this date to this date to 115,000. And then we do a weighted average of those 24 months of your annual salaries, base pay, okay? And then that's how we come up with the AFC. So we're looking at your highest salary. So if for some reason someone got demoted, say they were a higher salary, a higher position, and then they got demoted to a lower salary right before retirement, we're going to go to wherever they were making the highest salary, and those are the salaries that we're going to use in order to calculate that AFC to be used towards their retirement or even towards their drop.
Okay, we did get a couple more questions. So this comes from a police department member. What happens to the military credits if it was used to enter drop at 22 years? Will it increase the drop retirement percentage? I'm sorry, will it increase the retirement percentage upon retirement?
Exactly, yes. Because what happens is that, so time, well, I'll say like this, time equals money. So the more time you have, the more money you have. So if we're adding 3 years to your service credit or your time, that's going to be more money that we're also adding to that retirement benefit or to that, basically to that retirement benefit. So even if it's going into drop 2, it's still going to be more time, it's going to be more money, which is going to increase in the long run. It increases your retirement benefit. So anytime you're adding more time to your service credit, it equates to more money in your retirement benefit.
Okay, for the fire department, if you finish drop, does your first 20 years and 5 years get adjusted to your new salary?
So it depends on, let me read the question again, please.
For the fire department, if you finish drop, does your first 20 years and 5 years get adjusted to your new salary?
Okay, now finishing drop, so this is when we start getting in those different, what do we call them, levels of drop. So if you're complete drop 2, okay, so if you do your 3 years, now if you just, when you say complete drop, do you mean you do your 3 years of drop participation period and then you complete 5 years after that? If that is the case, then yes, we recalculate your benefit using only your new salaries. If you're talking about complete, people use complete drop to say I've completed my 3-year drop participation period and that's it, and I decide to retire, then no, we're not using your newer salaries. We're using your salaries, your AFC as of the day you went into drop 2, your drop 2 start date. We're using those older salaries. So if you want the newer salaries to be factored in and to be used solely to calculate all of your years of service, you would need to do the 3 years of drop participation and 5 years afterwards to have complete drop. And then we'll be using your newer salaries.
Okay, the member sending a clarification, or do you have to finish the extra 4 years after drop before your AFC is used for the first 25 years?
Yes, you do. You need to do 5, and you need to do a total. If you're in the fire department, you need well, let me just be real, 8 years. 3 years, if you decide to stay 3 years and drop 2, and another 5, it's a total of 8 years.
Okay, for police, after completion of drop 2, can I see online my totals throughout the years, meaning before the reports are issued? It was after completion of drop 2, can I go online to see it in real time, my totals throughout the year, meaning before the reports are issued, so before statements?
No, unfortunately, no. We have an advanced estimator, but it is based upon numbers as of our June 30th statements. So unfortunately, we don't have access to give you real-time numbers. The best way to see that is to request an estimate. And if you complete an estimate request form, an analyst will review your file, and they will take your, look at your current salaries. They'll analyze the file, and they're going to give you a pretty accurate estimate of what your benefit would look like as of a specific retirement date. But we, unfortunately, at this time, we don't have a way for you to just go in, any time you want to and just access what it looks like as of that date, real time. We don't have that capability at this point.
If you use your military and enter drop at 22 years, are you at 54% or 60% of your salary?
So that would be, I think it's going to be 60%. Let me do it quick. So if you're at 25, it's going to give you 60%. So if you go in, if you 22 years, and if it's 3 years of pre-employment military time, which you need 25 years, yes, it's going to be 60%.
All right. For the fire department, is the drop 2 account still earning the 5.5% interest during the 5-year recuperation period?
Yeah. Wait a minute. Read it again. I'm sorry.
For the fire department, is the drop 2 account still earning 5.5% interest during the 5-year recuperation period?
Yes, it is. So it earns 5.5% interest until your cutoff date. So when you decide to retire, whatever your cutoff date is, your termination date, whatever you will call it, your drop 2 account is going to continue to earn that interest up until that date. So yes, it does.
Okay. As of right now, that is all our questions. Wait a minute. We have one more. If you receive raises during the period in drop 2, 3 years, are those raises considered during evaluation of new AFC during mid-drop?
It is. However, it's only going to be applied towards the years after your drop 2 participation ends. So in those examples, I was kind of trying to show that to you. So if you complete drop 2 participation and you only do like 2 or 3 years, we're going to look at your new AFC, but it's only going to be applied toward those 2 or 3 years after your drop 2 participation ends. So it's not going to be applied towards the years, before you went into drop 2. So we do consider it, but it's not used towards all of your years of service, only the years after drop 2 ends.
Okay. We'll have another. Okay. For the fire department, is there a list of scheduled raises anywhere? If you're going to get a good raise, it probably makes sense to wait until after you get the raise before entering drop.
Well, we get the raises from the Office of the Labor Commissioner, and I know normally that it seems like they do it for like 2 years. They do it for 2 years. So, I mean, your department should have a list of it. I know we do. I know it should be, I think, on the Labor Commissioner's website, I believe, where they have a copy of like the I forgot what they call it. Oh my gosh. Whatever you like. What? Say it again.
The MOU?
Yes, the MOU, right. And then the MOU should have a copy of the raises that you all received. And like I said, normally I think they do it like for 2 years. They do it like 2 years at a time, I think. But actually, no. or fire department, not the way they've been negotiating. No, they've been doing it like a year at a time for you all. So I think right now, I think they just came out with July 1st, 2026.
The member says the MOU has steps.
Has steps. Is this police or fire?
Fire.
Fire. They said the MOU has what?
Steps.
Steps. I'm not sure I know what they mean. I know they have longevities, and they do have certain steps, and they have longevities. But yeah, in the MOU, it should include that. I mean, we do have copies that we can send to someone, but the most recent one we have is July 1st, 2026. And a lot of times, unfortunately, we may not see the raises until by the time it's negotiated, it may have already passed. I'll say it like that. So it's kind of hard to predict what the raise is going to be, because a lot of times it's happening kind of like real time, and sometimes by the time negotiations are finalized, it's after the raise would have happened. Like, say for example, I think July 1st, 2025, salaries may not have been approved until like February of 2026. So that's what I'm saying. So I mean, you can get copies of the salaries, but it's going to be kind of hard to judge how long you should stay based on the timing. I'll say it like that.
Okay, that's the last one. Go down.
Okay. Okay. So really quick, you all, we did come up with a drop two video, which hopefully will kind of summarize everything that I went over. And I just wanted to show you the trailer. And this official video will be available on our website today. And it's a lengthier video, which hopefully explains it and makes it a little bit fun. But I'm just going to show you a quick teaser so you can see it for yourself.
Think you know drop two? Think again. All of it. Yours, my effing peers.
What just happened?
We'll walk it with you. Get ready to understand drop two. What you learn next could change everything. Get the facts about drop two. Watch the official Drop 2 video on the FNP YouTube channel. Be sure to like and subscribe.
Great. So we finally were able to show it to you. So hopefully check out the full video.